Hey everyone, welcome back to another exclusive podcast from IronFX, where we're dedicated to bringing you the absolute best education to help you take your trading to the next level. I'm your host, Desmond, and today we're tackling a pressing question. Is inflation rearing its ugly head once more? With inflation accelerating in key developed economies like the US, Canada, and the UK, we'll explore what's happening, why it matters, and how it might influence markets and monetary policy. Let's dive in. Inflation is back in the headlines as price pressures re-accelerated in October across several developed economies. In the US, Core Consumer Price Index, CPI, along with Headline and Core Producer Price Index, PPI, all showed a pickup in inflation. This marks a reversal from the downward trend observed earlier this year. Meanwhile, in Canada, multiple measures of inflation, including median, trimmed, and common CPI, all pointed to a faster pace of price increases in October. These metrics are closely watched by the Bank of Canada as they provide a more nuanced view of inflationary trends. Over in the UK, Headline and Core CPI also accelerated, signaling renewed inflationary pressures in an economy already grappling with higher living costs. This resurgence of inflation is raising eyebrows and reshaping market expectations. With inflation accelerating, central banks like the Federal Reserve, the Bank of Canada, and the Bank of England are now in the spotlight. The big question is, how will this reversal in inflation trends influence future monetary policy decisions? After making successive rate cuts in September and November, the Federal Reserve could take a more cautious approach at the final FOMC meeting of 2024 on 18th of December, where they may hold rates steady while assessing economic conditions. However, if inflationary pressures persist and increase further, the Fed may have to reconsider additional rate hikes to cool demand and stabilize prices. Similarly, the Bank of Canada faces the challenge of balancing slowing economic growth with rising inflation. A continued uptick in core CPI measures could push the BOC to slow down the pace of future reductions in their overnight rate, which currently sits at 3.75%. The BOE is already navigating a tough economic environment, with inflation running high alongside weaker economic growth. The recent uptick in CPI may prompt policymakers to maintain rates at current levels for an extended period of time or even increase them, despite concerns about the broader economic impact. Central banks are walking a tightrope, and their decisions will have far-reaching implications for global financial markets. Let's talk about how these developments might impact financial markets and which asset classes are likely to experience higher volatility. Equity stocks tend to react negatively to rising inflation if it leads to higher interest rates as borrowing costs increase and corporate profits come under pressure. However, certain sectors like energy and consumer staples could outperform, as they often benefit from higher prices. Bonds. Rising inflation typically drives up bond yields, leading to lower bond prices. This could result in heightened volatility in fixed income markets, particularly in long-duration bonds. Currencies' higher inflation and tighter monetary policy often support currency strength. For example, the US dollar, Canadian dollar, and British pound could strengthen if their respective central banks signal more rate hikes. Commodities like gold often serve as an inflation hedge, so renewed inflationary pressures could boost demand for precious metals. Conversely, industrial commodities might see mixed impacts depending on broader economic growth trends. Volatility. Overall, inflationary pressures could lead to heightened market volatility as investors adjust their expectations for interest rates and economic growth. To wrap things up, inflation's resurgence in October across the US, Canada, and the UK is raising critical questions about the trajectory of monetary policy and its impact on financial markets. Traders and investors should keep a close eye on upcoming inflation reports, central bank announcements, and market reactions to stay ahead of the curve. Thanks for tuning in, and in the meantime, do remember to subscribe to our podcast here at IronFX, where we're dedicated to bringing you the very best education to take your trading to the next level. Until then, stay informed and stay tuned.